Have you ever wondered how to grow your wealth? Let's address that curiosity by introducing you to a world of potential growth and prosperity, the world of investing. So, what exactly is investing? Think of it as planting seeds today to harvest fruits tomorrow. It's about putting your money to work, letting it grow over time, and reaping the benefits down the line. Imagine you have 100 seeds. You could eat them all now, or you could plant some of them and grow a whole orchard of trees. In the same way, you could spend all your money now, or you could invest some of it and grow your wealth. That's the essence of investing, making the most of what you have today to secure a better tomorrow. Now that you understand the importance of investing, let's dive into the basics. Investing can seem like a complex world, but don't worry. We're here to break it down into simple terms for you. Let's start with three basic concepts: stocks, bonds, and mutual funds. First up, stocks. When you buy a stock, you're buying a piece of a company. You become a partial owner. That's right, you get a slice of the pie. If the company does well, the value of your stock goes up. If the company doesn't do so well, the value might go down. It's a bit like a ride on a roller coaster, exciting but potentially risky. Next, we have bonds. Bonds are like IOUs. When you purchase a bond, you're essentially lending money to a company or government. In return, they promise to pay you back with interest over a certain period of time. It's a safer ride compared to stocks, but the returns might not be as high. Lastly, there's mutual funds. Think of mutual funds as a basket of various investments. They can include stocks, bonds, or other types of investments. When you buy a share of a mutual fund, you're buying a piece of everything in that basket. It's a great way to diversify your investments and spread the risk. Now, you might be thinking, which one is the best? The answer is it depends. It depends on your financial goals, your risk tolerance, and your investment horizon. But don't worry, we'll dive deeper into these topics in our upcoming scenes. Remember, investing isn't about getting rich quick. It's about growing your wealth over time. It's about making your money work for you. In the world of investing, knowledge is power. So keep learning, keep asking questions, and most importantly, stay patient and disciplined. Understanding these basic concepts is the first step to becoming a successful investor. Before you start investing, it's crucial to set clear financial goals. Picture this. You're about to embark on a journey to a destination you've never been to before. Now, would you set off without a map or a clear idea of where you're going? Likely not. The same principle applies to investing. Without clear financial goals, you're essentially navigating the financial landscape in the dark. So, why are financial goals so important? Well, they provide direction. They act as a roadmap, guiding your investment decisions and helping you prioritize where your money should go. More importantly, financial goals give you a clear picture of what you're investing for, and that's a powerful motivator. Now, these goals can be short-term, medium-term, or long-term, and each type requires a different investment strategy. Short-term goals are those you hope to achieve within the next 2 years. Let's say you're saving for a vacation or to buy a new car. For such goals, you want investments that are low risk and highly liquid, like a savings account or a short-term bond. Medium-term goals, on the other hand, are those set for 2 to 5 years down the line. Maybe you're planning to buy a house or start a business. For these, you'll need a balanced approach, a mix of growth and income investments. Bonds, mutual funds, or dividend-paying stocks could be your go-to here. Lastly, we have long-term goals. These are goals set for more than 5 years into the future. Retirement, for instance, is a common long-term goal. For these, you can afford to take on a bit more risk for the potential of higher returns. Think of investments like stocks, real estate, or even your own education. Remember, the key to successful investing is aligning your investments with your financial goals. It's about understanding what you're working towards and using your money to get you there. And of course, the earlier you start, the better. So take some time today to think about what your financial goals are. Write them down, make a plan, and then take the first steps towards achieving them. Because remember, a goal without a plan is just a wish. One of the key strategies in investing is diversification. Now let's unpack this term. Diversification, in the simplest terms, is a strategy that involves spreading investments across a variety of assets to reduce risk. Imagine a farmer who only plants one type of crop. If a disease strikes that particular crop, the farmer could lose everything. But if the farmer plants a variety of crops, the risk is spread out. Even if one crop fails, others might thrive. This is the essence of diversification in investing. Instead of planting crops, we're investing in assets like stocks, bonds, real estate, and possibly even commodities. The idea is to spread out potential risks and rewards. In other words, we're not putting all our eggs in one basket. The saying, "Don't put all your eggs in one basket," is a perfect analogy for diversification. If you put all your eggs in one basket and that basket falls, you lose all your eggs. But if you spread your eggs across multiple baskets, a mishap with one basket won't wipe out all your eggs. It's essential to remember that diversification isn't about maximizing returns. It's about managing risk. If one investment performs poorly, others might perform well, balancing out any losses. Now, how do you diversify your investments? It's not just about investing in different companies, it's also about investing in different industries, different countries, and different types of investments. For example, you might invest in technology companies, retail companies, and utility companies. You might invest in companies in the United States, Europe, and Asia. And you might invest in a mix of stocks, bonds, and real estate. The exact mix will depend on your financial goals, your risk tolerance, and your investment timeline. It can be complex, which is why many investors choose to work with a financial advisor or use diversified funds like index funds or mutual funds, which spread investments across a broad range of assets. Remember, diversification doesn't guarantee profits or protect against all losses. But it can help manage risk and smooth out the bumps in the road of your investment journey. Diversification can help protect your investments from the unpredictable market. Another effective investment strategy is dollar cost averaging. Now you might be wondering, what exactly does that mean? Well, dollar cost averaging is a strategy where you invest a fixed amount of money in a particular investment at regular intervals, regardless of the price of that investment. Think of it like this. You're on a shopping spree, but instead of buying everything in one go, you're spreading out your purchases over time. Some days the prices are high, so you get less for your money. Other days the prices are low, and you end up getting more. But over time, you're aiming for an average cost, not the absolute lowest or highest price. Now, why is this strategy effective? Well, it's all about reducing the impact of market volatility on the overall performance of your investment. When the market is on a roller coaster ride with prices going up and down, it can be tempting to try and time your investments to buy low and sell high. But here's the thing. Even the most experienced investors find it challenging to time the market consistently. That's where dollar cost averaging comes in. By investing the same amount at regular intervals, you buy more shares when prices are low and fewer shares when prices are high. Over time, this can result in a lower average cost per share than if you tried to time the market. It's also a strategy that encourages disciplined investing. You're committing to making regular investments regardless of what the market is doing, and that discipline can pay off in the long run. But remember, like any investment strategy, dollar cost averaging isn't foolproof. It doesn't guarantee profits or protect against losses in declining markets. And it requires a commitment to continue investing through all market conditions, which may not be suitable for everyone. Dollar cost averaging can be a smart way to invest, especially for beginners. It's a strategy that can help you navigate the ups and downs of the market and potentially build wealth over time. So the next time you're considering your investment strategies, why not give dollar cost averaging a thought? Investing is not about getting rich quick, it's about building wealth over time. Now that's a phrase that embodies the essence of a long-term investment strategy. When we speak of long-term investing, we're talking about the practice of buying and holding investments for an extended period. This strategy is not about timing the market or making a quick buck. Instead, it's about patience, discipline, and the magic of compounding. Imagine planting a tree. You wouldn't expect it to bear fruit the very next day, would you? It's the same with long-term investments. They need time to grow and mature. And just like that tree, the fruits of your investments can be bountiful with patience and care. One of the biggest advantages of this strategy is the power of compounding. Compounding is the process where the interest earned on an investment is reinvested, and then that reinvested interest earns interest of its own. Over time, this can lead to exponential growth. Albert Einstein once referred to compounding as the eighth wonder of the world, and for a good reason. It's like a snowball rolling downhill, gaining momentum and size as it goes. Another benefit of long-term investing is the potential for market growth. The stock market, for example, has historically trended upwards over the long run. This means that despite short-term fluctuations, a long-term investment approach can help you take advantage of this upward trend. Now, it's important to remember that long-term investing doesn't mean you set it and forget it. Regular reviews and adjustments are necessary to ensure your portfolio stays aligned with your financial goals. But overall, it's a less stressful and more hands-off approach compared to short-term trading strategies. In the world of investing, patience truly is a virtue. It's about understanding that wealth is built gradually, not instantly. It's about realizing the power of compounding and the potential of market growth. So, as you embark on your investment journey, keep the long view in mind. Remember, the goal of investing is to build wealth over time, not overnight. Investing is not a set-it-and-forget-it activity. Regular review is essential. It's like tending to a garden. You wouldn't plant your seeds, then just walk away, would you? No, you'd water them, check on their progress, and sometimes even move them to a better spot for growth. That's the same approach you should adopt with your investments. Regularly reviewing your investment portfolio is like tending to your financial garden. It helps you assess how your investments are performing and whether they're on track to achieve your financial goals. This is particularly important in the ever-changing financial landscape where market conditions can fluctuate rapidly. A stock that was a superstar last year might be underperforming this year. A sector that was booming might be on a downward trend. By regularly reviewing your investments, you can identify these changes and make necessary adjustments. Reviewing your portfolio isn't just about tracking the performance of individual investments, though. It's also about ensuring your overall investment strategy still aligns with your financial goals. Maybe your life circumstances have changed, and you now have different financial needs. Perhaps the risk tolerance you had when you started investing is not the same as now. Or maybe your timeline for reaching your financial goals has shifted. Regular reviews allow you to adjust your investment strategy to these changes. Additionally, reviewing your investments regularly can help you rebalance your portfolio. Over time, some investments may grow faster than others, causing your portfolio to become unbalanced. By rebalancing, you can ensure your portfolio maintains the right mix of assets to match your risk tolerance and investment goals. So, how often should you review your portfolio? While there's no one-size-fits-all answer, a good rule of thumb is at least once a year. However, if there are significant changes in the market or your personal circumstances, more frequent reviews may be necessary. In conclusion, regular reviews are a crucial part of successful investing. They help you stay on top of market changes, realign your investment strategy with your financial goals, and maintain a balanced portfolio. Remember, investing is a journey, not a destination. And just like any journey, it requires regular check-ins to ensure you're still on the right path. Regular reviews ensure your investments align with your financial goals. Investing may seem complex, but with these strategies, you're well on your way to growing your wealth. We've journeyed through the realm of investing, demystifying its complexities and laying bare its principles. We started with the importance of investing, highlighting how it's not just about hoarding money, but about growing it. We then dove into the basics of investing, brushing up on key terms and concepts that form the foundation of any successful investment journey. Next, we established the importance of setting clear, achievable financial goals as a guide to your investing journey. We explored diversification, a strategy that spreads your investments across various assets to minimize risk. Similarly, we touched on dollar-cost averaging, a technique that involves investing a fixed amount regularly, irrespective of market conditions. We also stressed the significance of long-term investment and the magic of compounding. Lastly, we reminded you of the importance of regular review to keep your investment strategy on track. Remember, the journey of 1,000 miles begins with a single step. Start your investment journey today and watch your wealth grow. Don't forget to subscribe for more interesting facts and strategies on investing.